mother went to the kitchen. We store rice in rice cans. She dipped her hand and she basically took out a packet, which was her savings for the last many years. And from her savings, she gave me that 30,000 rupees. So even now, I feel that I was blessed.
What is your personal opinion on the importance of profitability of a business at some point in time, with a valuation, or is it actually okay for a company not to make money for 20 years?
An ability to execute the plan. So I made an investment. I was an early investor in Seattle. Fast track now, 2021. You'll be happy to know that, and it's in public domain, that the company raised $15 million.
Wow. Hey guys, thank you so much for joining me today on Ashish Janiani. Today's investor guest is an outstanding human, a personality that as an entrepreneur, you're definitely going to pick up some heartly things from outside the intellectual things, which is obviously the target as well. This man has got 23 years of global experience, 19 years of experience as an active investor, has invested in 60 plus companies, out of which 2 have been unicorn exits. Okay. This man is primarily into healthcare. His story is going to touch you because of how he reached from India to Singapore and made himself what he is today. It's just something that's just beautiful. So without any further delay, please help me welcome Dr. Anand Govindaluri. Hi, Dr. Anand. Good evening here. How are you?
Yeah, hi. Good evening to you, Ashish. How are you doing?
I'm doing great. First of all, thank you so much for joining us for this interview. But before we ask you the questions that startups would be excited about, I think it's very important to know your journey of how did you reach where you are today and what were the life learnings that has made you have the philosophy that you have today.
So the simple answer to this question is, Ashish, is keep learning. And there is no fixed formula. There's no magic formula for learning. In fact, there's no substitute for hard work. I come from a very humble middle class family. My dad is an organic chemist. And as a PhD scientist, I was always very impressed with the pharmaceutical innovations and the technologies that he would talk to me about. And our conversations over coffee or over a meal would always be about new innovative technologies. And because of his blessings, I actually became a microbiologist followed by a biotechnologist. I never thought I would be an investor, to be very honest. I was good in science and I was good in the subject of understanding biotechnology. It actually fascinated to me a lot. And I spent some very interesting time and years at in a very premier medical institute called All India Institute of Medical Sciences in New Delhi. And subsequently, I spent some time at a university called JNU, Jawaharlal Nehru University in New Delhi. So those were the initial years which basically sparked interest in the subject of biotechnology. And when I came to Singapore, this was in 1997. Singapore basically being a very vibrant hub for life sciences and biomedical sciences, it was quite automatic and very quickly I realized that there is something that makes the place vibrant, and that is finance. And that's something which I wanted to learn. And it was very odd for my friends to basically know that someone with an academic background or a science background is actually interested in finance. Even my teachers were surprised. But I ended up basically taking up a degree in finance. I did my MBA. And post that, I joined an investment company, which basically was the turning point in my life. And with that, I learned the tricks of the trade, as what they say, and the art of investments. The chances of probability of success is actually is very low in investments because many a times it's not just about the idea, it's about several other variable factors. So So I would say that to be an investor, in fact, I could become an investor because of being at the right place at the right time, and opportunity when it knocks, you have to learn how to seize the opportunity, and be always curious to learn.
Great. Wow. So first of all, I think your dad had a lot of influence on you, and you had that support. And a lot of people find that in different people. But I think mentorship is key of how do we find our own path in our own ways. And a lot of it also came through with time, with you finding yourself. But I think it started with your dad, and I think he played an important role in your life.
Yeah, I wanted to be a medical doctor, and I was actually preparing for medicine. But during that time, when my father he brought this subject, he introduced me to the concepts of microbiology and biotechnology. I was fascinated with that. So, as a young child, I actually listened to my father, and now I thank him wherever he is. He's no more with me physically, but I'm sure wherever he is blessed me and is blessing me with understanding the art of investments in biotechnology.
Yes.
Let me also add that my mother was instrumental in sending me to Singapore.
Okay, how come? Can you give a quick story on that?
So, though I was actually earning in India, it was not enough, and so I remember that I got a scholarship to come to Singapore, and the scholarship did not cover airfare, and so the airfare was sponsored by my mother. And I remember this, that when I wanted 30,000 rupees way back then, I'd asked my mother, and my mother went to the kitchen. We store rice in rice cans, huge rice cans. So she dipped her hand and she basically took out a packet, which was her savings for the last many years. And from her savings, she gave me that 30,000 rupees. So even now, I feel that I was blessed, and I took that money and I came to Singapore.
Wow. Yeah, that's very personal, and I think a lot of us can relate to it as kids to our parents, of how much these little things that you say, right? Having that money in the pot, saving it for us, and that's beautiful. Okay, great. You mentioned a few points about investments, since that is the next part of the discussion today. I want to ask you 2-3 questions from the conversation we've had so far. You mentioned that the chances of a startup getting funded is very less. So if we can give a percentage to that, because what happens is that the younger guys between the age of 20 to 30, where a lot of tech development is happening, I think the news is kind of just showing them the good news of everybody getting funded. And coming from somebody like you, I think they should know the reality of stats so that they can be prepared of the hard work which has to be put behind. Second is, what are certain things from a philosophical perspective of an investment? As you mentioned, there are a lot of things that an investor looks at. We can talk about, and if you can club that, in fact, the philosophy with an example of a company that you did not invest in versus a company that you invested in, because I think the did not will hit them more, because a lot of companies have got invested. So if you can, answer these questions.
Yeah, great question. In fact, there are several layers in your question. So let me just begin with the first question, where you asked me about what it takes to make an investment. I think many times people forget, or startup entrepreneurs, they forget that investment is not about business plan. It's about chemistry. It's about chemistry between the investor and the founder. And it is important that many a times the founder tries his best to impress the investor. What is important is that the investor essentially is way ahead in terms of analyzing and evaluating not just the business plan, but also the founder's mindset when he's meeting with the founders. So it is important for the founders to be authentic, to be honest, and to be genuine in their ideas when they're pitching to an investor. That's number one. Number two is how cool is actually the idea. Many a times we look at the idea and then you say that it's pretty cool, but I don't look at the idea. I look at the problem. I look at the size of the problem. And let me tell you, bigger the size of the problem, better would be the success rate or the chances of success. Many a times, young entrepreneurs from India, or for that matter from Singapore, they come to me with a solution. And they say that I have an app, and would you like to fund the app? Now, I ask myself, why would I want to fund an app? I'm here in the business of making investments in companies that can actually be institutionalized. So I'm looking for institutionalization of thought process, institutionalization of governance, institutionalization of the entire business plan or the business model. Now, so it is important that a founder is well prepared before he goes and pitches himself, pitches the idea to an investor. So seldom they focus on the problem, and it is so important to focus on the problem. In fact, actually 99% of your time you should focus on how important the problem is. And I've given many, and I can share many examples of investments where I was way ahead of the curve because I was actually focusing on some very large problems, especially in healthcare. Way back in early 2000, in fact, many of my early investments were in the field of cancer, oncology. And if you see down the lane, fast forward 20 years ahead, it still is a very major problem. So breakthroughs in cancers are happening, but not at the pace at what it is supposed to happen. So larger the problem, and also it would mean that there would be more focus on more chances for the success of that particular startup.
Okay.
Then, very important thing is, in addition to these 2 points, the third point is about who are the people who are actually behind you. A startup is not about one-man team. It is about a management team. It's about mentors. It's about advisors. It's about the board and the entire syndicate to come forward and solve a particular problem in a very strategic manner. So we do give a lot of emphasis on the management team and the board and the board of advisors. So I think these are some of the factors that I take into consideration before I decide whether I should invest or not. And many business plans that come to me, I do not invest in them because I don't find these ingredients. But more importantly, let me just share some insights about what impresses me the most. I like founders who basically share with me in their very first meeting about the vision. What's a dream that they're trying to, because when you are meeting an investor the first time, you actually want to share a dream and you want to share your vision and then actualize it or actually work towards that particular dream and making it a reality. It's not a transactional relationship. I know at the end of the day, you're looking for an investment from an investor, but it's not a transactional relationship. It's about basically how you're going to spend the next 5 years of your own life with that particular idea or the problem that you're trying to solve. So
yes. And can you give an example? Maybe it's happened with you that you were close enough to invest in a company which met a lot of the things that you spoke about right now, but then something happened at the later stages where you decided not to invest. Things happen. So without taking names, if you can give a real life example to the audience, it would help them. And also a percentage of how many companies in the world actually get invested, it would help them.
See, I have so far invested in 64 companies, and this is over the past 20 years. So an average hit rate of about 3 to 4 companies every year. Okay, but to make these investments in 64 companies, it has actually taken me more than, I would say, 500 companies, or maybe even, between 500 to 1,000 companies that I may have evaluated, or business plans that I may have evaluated before I could come to the conclusion that these are the top companies that I have to invest. So every business plan that comes across me will not get funded. In fact, 1 in 10 get funded. And now post, let me tell you that things are also likely to be much more slower and not faster because of the market situation and also the financial situation. Obviously, there are some sectors like healthcare, edtech, that have actually been accelerated, or digitalization, wherever business plans with digital business models or digitalization is part of their strategy. Those type of companies are getting funded very fast. But many a times, investors, I've noticed that they're becoming more and more cautious, because when you make an investment, you're also planning about, you're also thinking about the end at the beginning. And you're also thinking about how the end is likely to be 4 or 5 years or 6 years down the lane. And if the market conditions are not favorable, or economically they're not doing well, then that could also dampen the investment flavor. So, I want to actually share through this particular interview the message that founders should not be disappointed if they don't get investment, because investment is subject to ideas, it's subject to management team, it's subject to various other market factors, economic factors. And last but not the least, it's also the ability of a founder to raise the money. If the founders are not in the position to raise money, then there's very little that an investor could do, because I may be interested in a startup and I may commit to certain investment, but then at the end of the day, is he in a position to raise capital to the extent of what it requires for creating that value inflection? And that value inflection basically can only come when you have enough capital that you have raised through your syndicate.
Okay, got it. Understood. So I would love if you could give an example, but I will also club it with this question actually, because you spoke about valuation. I think there is one thing about financial investment, which is valuations, and then there is another thing about business, which is profitability. Now, for instance, a lot of startups, because of the education system that we have, they work upon the understanding of debits and credits, but they don't understand valuations. For example, Flipkart's not made money, or Zomato, has not made money or is incurring some losses, but these are big companies with big valuations. What is your personal opinion on the importance of profitability of a business at some point in time, with a valuation? Or is it actually okay for a company, and it's a broad question, but is it okay for a company not to make money for 20 years and have a high value? Because if that does not work out, the founders are going to be fine because of the number of investments they've got and the perks that they have. But what happens to the economic condition, especially in countries where now the economy is relying on that particular business in a lot of ways? It's a very important question. And later, if you can give an example, I will summarize the interview.
I'll give you a couple of examples. In fact, actually, I'll pick up examples from my own investment cases. So let me just share the name of a company. Okay? It's called BioVex, a spin-off company from University College London, focused on cancer vaccines. And the year was 2001 or 2002. That was the year when I visited UCL and I met up with the founders of this company. Two founders from the Department of Virology in UCL, Professor David Lachman and Professor Rob Coffin. Professor Rob Coffin was an assistant professor, and Professor David Lachman was his mentor. So they shared the data about how viral vectors would basically play an important role. And at that point of time, they were talking about herpes simplex viral vectors. So these are vectors which are used to clone genes for the treatment of cancer.
Okay.
And it was a startup company. They had a team size of about 6 or 7 members. And obviously, being a startup, they were looking to raise somewhere around, I think, about £7 million, and at a fairly reasonable valuation. But what was apparent to me is that they would not make money at least for the next 4 years or 5 years, even after the investment is made. And that's because that's the nature of the game in biotechnology. You have to have systematic way of doing the experiments, especially when you are investing into an early stage healthcare or a biotech company. You have to go through the animal trials. You have to go through the human trials, and human trials are in 3 phases: phase 1, phase 2, phase 3. And then you would basically know whether you have a successful molecule at the end of phase 3. And in between, if they fail, and most of the times they do fail, and that's it, the investment goes kaput. So when I made this investment proposition to my investment committee, then way back in 2002, it was actually shot down. And because for the obvious reasons, the IC could not see traction in terms of revenue visibility or in terms of profitability, right? But then what was important is they had something very strong patent portfolio. They had very strong IP. The barrier to entry in life sciences companies has to be relatively very high. So it was not a Me Too company. It was basically an innovative, disruptive company. I was successful in convincing my investment committee to make an investment, and that's how we made an investment there. I also served as a member of the board as an observer. And over a period of the next, I would say, 4 years, the company was headquartered in UK. They ran out of money. And that amount of time, the board did something phenomenal. We actually decided that we're going to start a presence in the US, okay? And there was the CFO of the company who was promoted to be leading this initiative in the US. And he was also assigned the responsibility to raise money out in the US. And that was the turning point in the company. In fact, we ended up raising a lot of money to do the clinical trials. And you'll be happy to know that the company got acquired by a leading biotechnology company known as Amgen.
Okay. Wow.
Amgen bought this company for $1 billion US.
Wow. When did this transaction happen? Which year?
Transaction happened around 2008.
Wow.
2009. So it took a cool 8 years before you could see exit, and the exit was a unicorn exit. So I have 2 unicorn exits, in fact, to my resume. And almost about 16 or 17 exits that I've seen, positive exits. Let me just share with you one more example. In fact, I'll share more recent investment.
Okay.
The company is again based, so this is the second company. So I shared with you about BioX, which is out of UK. And now the example that I want to give you now is about a company in Singapore, which is known as Cialfo. It's a company which is in the business of edtech, education. Okay. And they have a phenomenal AI-based platform that they have developed to counsel students in terms of their applications to getting admissions in colleges and universities in the West, especially the Ivy League universities. Okay, and this is a huge business. We didn't realize when I invested in this company in 2016. The founders were 2 young founders who just graduated with an engineering degree from the Nanyang Technology University in Singapore. And what I could see in the founders, in the 2 founders, was basically, again, the same traits, what I've shared earlier, a vision, honesty, and an ability to execute the plan. So I made an investment. I was an early investor in Cialfo. Fast track now, 2021. You'll be happy to know that, and it's in public domain, that the company raised $15 million US.
Wow.
Very, very attractive valuation, creating substantial value for all the early stage investors in the company. So again, what I want to emphasize here is that it's not about just revenue generation or profitability. It is about creating that vision and that story, which investors are able to connect with the founder's vision, and especially addressing a problem in the current situation. So post, the importance of digitalization has been accelerated. And investors are looking for edtech companies where they are able to invest in opportunities that can scale up, ramp up the businesses in a fast manner. So an equivalent of that example in India would be Byju.
Yeah.
So if Byju's growth, it's because, by the way, Byju took a good 10 years plus to reach where it is. In the case of Cialfo, in fact, it's been less than 4 years. But what has happened is that it's a matter of timing. It's a matter of timing. It's also a matter of the market opportunity that is created at that point of time for an investor to seize. What happens is that when the founders are authentic and genuine with the investors, and investors are also genuine with what they feel, then there is a good, I would say, relationship and an equation that comes out of this whole interaction.
Wow. So some science for the doctor, right? That I learned recently, and I think you may know it. But from a neuroscience perspective, I've been studying neuroscience for a year now. The vibration that the heart produces when you are being genuine is 5,000 times more magnetic in field than the mind. And I think that's what genuineness actually means, that you feel the energy and people can now measure it.
Yeah, exactly. And so if founders basically are willing to learn, they're willing to be mentored, they're being honest about their fundraising abilities and capabilities, and also the funds that they're going to raise and the plan that they're going to essentially execute eventually, I think definitely it's possible to build a successful company. So again, when I take the example of Cialfo, when I invested in 2016, they had a team size of 4. Today, we are close to 70.
Wow.
So, this is a classic example as to how you can build successful companies. Now, let me take another example. Another edtech company out in Singapore, which is called AgTech Technologies. This company is quite unique in many ways because it's one of the very few startups that I come across which is not only revenue generating but also profitable.
Okay.
And so it's the only portfolio actually. It's the only company in my portfolio which is profitable, and they've got very healthy profit margins. And let me tell you, they surprised me this year by actually auditing their financials. So how many startups do you actually find who engage auditors and audit the financials? It actually, in fact, it's not required. But when you do it, it means that you are elevating or you are improving and increasing the bar level of governance, financial governance in a particular company. And that gives you confidence to put more money into the business. So you have some great examples out there of startups that have made it because they were disciplined, they had a vision, they were willing to learn, they were not basically egoistic. And at the same time, they built a board and a management team that really could scale the business plan. Now, let me share with you why startups fail. The single biggest reason why startups fail, and I have failed in 20 ventures. In fact, 20 of my investments failed. Out of the 64, 20 of them failed. And I'll tell you 3 important reasons. It's not possible for me to cover everything. The single biggest reason is the mindset of the founder. If the founder gives up, or if the founder has got ethical issues, or if he's compromising on integrity, or if he's compromising on not fulfilling the business plan, what he had showcased to the investors at the time of taking the money, these type of founders are a big no, and they're also a big put off. Okay, that's number 1. Number 2 is their inability to let go of the controlling attitude of a company or of a board. So what happens is that you have to realize that once an investor puts money, he's actually looking at the good interest of the company because his money is there, and also at the same time he wants the founders to succeed. But even after an investment is made, if the founder continues to be having a controlling attitude, then those type of companies seldom take off. The third is the business model. Many a times what happens is that you have great ideas, you have great vision, you have great, I would say, aspirations, but you can't make money. The harsh reality is that startups survive on your ability to make money. Either you need to have shareholders who have deep pockets, who can fund till for many years, or you must have basically a business model that generates cash. And if you do not generate cash, then you are dependent on the lending organizations like the banks or other lenders to basically give you capital. And then that's a time when you feel that your balance sheet is stretched, or your balance sheet is absolutely, I would say, in a different manner, which is not in a position to, not attractive for raising more capital. The third reason why startups fail is they need to understand that any investor who comes into a startup essentially is there not just to create value, but also to make money for themselves. The investors are actually in the business of making money, right? So you need to create an exit. So to create an exit, you also have to have exit strategies put in place well in advance, and that's where the board plays an important role in designing exit strategies for a company. And many startups don't actually invest time in building strong boards. They don't invest time in building strong mentors. They don't invest time in building strong advisors. They are too focused on the transaction, on the operational details. They're too focused on basically surviving. But what they don't understand is that it is a catch-22 situation. If you don't have a board, or if you don't have a world-class management team or advisors, it's not possible for you to raise a lot of money. So investors look for these salient features before they invest big sums of money.
Wow. Well, thank you so much for those examples. Those are very valuable examples. There's a lot of insight that you've given right now. I'm just thinking about going through those examples again, because what you said has to be practiced diligently,
yes.
By a startup. And I think at the core of it is honesty to be good, like to be doing your best with a great business model and looking for help, being okay with that help and solving a problem. And I think you also have to adjust, right, with the market when you're solving that problem, because the problem of the market also changes.
Absolutely. And you have to adjust, and if there are problems, you should actually tell the bad news right up front to an investor. Many a times founders end up basically creating positive stories. We don't need positive stories. What we need is basically actual stories or actual facts, actual data. Are you doing well? If you're doing well, why are you doing well? And if you're not doing well, why not doing well? Okay. So founders who are hesitant in sharing the actual data and instead create positive stories eventually are in a bubble. And when the bubble bursts, it's very painful for the founder.
Yeah. Great. So
I will also share an example of a founder who actually couldn't make it despite having a lot of capital. And it was an investment that I made. It's a spin-off company from University of Connecticut in the US. They were in the business of microarrays. In fact, they created a panel of genomic arrays and protein arrays. And the founder, in fact, he raised a good $14-15 million. But he was very miserly in the way he was spending money. He didn't have a sense of how to spend money. And by the time he got his product out, the market or the innovation curve had moved ahead. And so there was no takers for that product. So what happens is that it's all about timing. You see? So even when you are in the business of innovation, you have to launch your product at the right time. What was good a few years back may not be relevant now.
Wow. Great. So I want to summarize this. This is amazing. Thank you so much. I just want to ask you that one question. So valuations are important. Solving problems is important. Right team is important. Is profitability at some point in time important, or valuations and the first premises is the key? Even if we've not been able to create profits in the next 10 to 15 years, would that still make a company sustainable?
No. So basically, if you are dependent on the shareholders' capital, don't forget that the shareholder is expecting a return on the investment. Where are you going to get that investment? So you'll have to look for the next deep-pocketed shareholder or the investor to refund the exit or to refund the investment amount of the previous shareholder. So rather than basically working on that VC model or that financing model, it is important that after a few years, you build in strategies to grow your business and grow your business in such a manner so that you have strong balance sheet.
Yes, good. Okay. So let's summarize this. This is not in there. Let's look at the future, and the future nobody knows, right? But we still have to guess. And what more than your expertise? How do you see the next decade of entrepreneurs be? Okay, what kind of disruptive entrepreneurs and technologies can you visualize that and give us a vision for that?
I'm a firm believer in innovation, and as I just shared with you, what used to take about 10 years or 15 years, now we are basically seeing new vaccines coming up in 1 year. What does it mean? It tells you that essentially the advances of science and technology is so robust. And also the ability, the will, the resilience, and the resolution of founders has actually improved substantially. There's a quantum jump in the way founders are looking at problems. I strongly believe that a combination of the two is going to pave a golden path for innovation to happen in the next decade. Coupled to this, the size of the market. And if you have a large market size, especially a domestic market, which is as large as what you see in India, I think then you are into something very, very interesting. And that's how you see not just unicorns being produced, but you're seeing some great companies being actually born out of the problems that exist, but also because of the entrepreneurial ecosystem that has been nurtured over a period of time.
Yeah.
So the next 10 years is going to be the golden age of innovation. And in this golden age of innovation, the time for Asia has come. The best part of this entrepreneurial journey is that you are able to solve not just your problem, but you're also able to solve others' problems. And when you have a purpose like that, entrepreneurship becomes fun, investment becomes much more easier, and the ability to make money is also well defined.
Yes. And I think all these good entrepreneurs who've learned from mentors like you, they will be reinvesting that money in the market, passing on the baton from you, teaching other people. And I think that community built up is going to be exponential.
So this is the fun part of being an investor, is that when you do good investments, you not only benefit yourself, but you also benefit the community around you. And I encourage each and every investor to think about basically contributing back to the society in some form or the other, because that's when you can create a better world for tomorrow.
Yes, we are going to leave all the money behind, right? So why not just use it for the good things that you're saying, correct? It's all going to be here.
I think institutionalize the vision of having a purpose. That's how I look at it. So to me, investment is every time I make an investment opportunity, I say that this is getting me closer to my purpose, and the more the better.
Yes, great. What a thought, and you are absolutely right. I teach on sales, and I say money is a good thing. You got to know that it helps you move the economics around, and only when you are rich can you impact more. So know that it's your ethical duty to be rich if you're educated and you are capable, which we all are, right? So I completely agree with you, and I'm so glad that you said that. So where can startups connect with you? And I'm sure you connect with other investors, but a lot of new investors will be in the market, and this video will be there forever. So maybe some startup today might watch it when he or she is an investor later. What's the best way to get in touch with you for conversations and business ideas?
So very early in my life, I've learned that any email that comes into your mailbox should always be responded. So I make it a point of responding to each and every email. Sometimes I may be a bit slow because of the just the
frequency
work and the frequency. But an email would be the best way. So anyone who wants to get in touch with me should email, and then I'll follow up, or somebody from my team will follow up, so that we are able to hear. So we must empower every entrepreneur. We must give time to every entrepreneur, at least to hear their story. And that is a resolution that I made when I became an investor, that I'm not going to say no to an entrepreneur or a founder just because I don't have time. I would say no only because I don't believe or I don't think that this is going to be a successful business model. But then take out the time, and time is the biggest commodity or the biggest asset that I'm actually sharing with the founder. So in that 30-40 minutes of my time which I give for the founder, if I decide to make an investment, well and good. Otherwise, I'm sure that the founders will learn a lot from the experiences of how it's not about how you make money, it's also about the lessons I learned from my failure stories. And sometimes failure stories basically give you more important messages and better stories also for everyone.
Yeah, you are a rare man, and this message is for other investors. Is a request from a lot of startups that your time, sometimes it's not the money, but your 30 minutes of insights can also help the right company. So please, because I think whatever you've achieved so far can help us make this planet a little bit more better with our efforts that we are putting in today. And thank you so much. It means a lot. I can't say it enough.
Thank you, Ashish. Thank you
Yes,
for the
thank you so much.